Good morning, everybody. My name is Catherine Connolly. I'm from Economic Sense, and a very warm welcome to all members of the Society of Professional Economists who are joining us this morning. Well, yesterday, Chancellor Jeremy Hunt delivered his 2024 budget. On the Treasury website, it is entitled The Budget for Long-Term Growth. And joining us today are Tom Josephs and Steve Farrington from the Office for Budget Responsibility. Tom Josephs is a member of the Budget Responsibility Committee. He was actually the first Chief of Staff at the Office for Budget Responsibility back in 2010, there when it started, and he's had a variety of roles in Whitehall, including at the Treasury. He's worked on pensions and international trade, and he's also worked at the International Monetary Fund. Joining him will be Steve Farrington, who is the Chief of Staff at the Office for Budget Responsibility. We were just chatting and he was also there when it was set up. Steve leads the teams who put together the forecasts and the research that is used by the Chancellor. And Steve has also undertaken a variety of roles as a civil servant at the UK Treasury. So I'm just getting someone saying that they can't hear anything. Just let me check. I think hopefully most people can hear us this morning. And I would just like to extend there a warm welcome to Tom and Steve. Hello, good morning.
Thanks, Catherine. Hi, everyone. Great to be here with you.
Fantastic. And I will now just say we're going to hand over to Steve and Tom, who are going to present some slides for us today. They've kindly agreed to take your questions this morning. You can put your questions in the Q&A. There should be, if you scroll down to the bottom of your Zoom screen, there is a Q&A and you can put in your questions at any time. But first up, I believe I'm handing over to Steve, and Katie is going to share those slides. Over to you, Steve.
Great, thanks very much, Catherine. Okay, let's get started. So the first thing to say is that it's only been 3 months since our last forecast in November. And thankfully, it's been a relatively uneventful period, at least by the standards of recent years. But I will take you through the things that have changed since our last forecast. So next slide, please. The first of which is that inflation has come down much more quickly than we expected in autumn. We now expect it to fall below the Bank of England's 2% target in the second half of this year. That's due to falling energy prices and the effects of cooling domestic labour market. Thereafter, we expect inflation to remain a touch below target through much of the forecast and gradually move back to 2% as the output gap closes through the forecast period. But obviously, recent experience means that we shouldn't be particularly complacent around the risks around our central forecast. We spend a lot of the time, hopefully if you have time to look through the EFO, you'll see we spend a lot of time looking at various scenarios and risks around our central forecast, including one where we look at an alternative adverse scenario for inflation where we assume that the disruptions in the Red Sea and conflicts in the Middle East keep shipping costs and energy prices higher than we assume in our central forecast. And in this scenario shown in the green line on the chart, that keeps quarterly inflation up above 7% through to 2025 and causes real GDP to contract by a further 1.1% at the height of disruption. And we examine some of the fiscal effects of that potential scenario in the EFO. Next slide, please. So the other big development since our last forecast is movements in interest rates. So markets now expect a sharper fall in rates than they did in November, and 10-year gilts are around 0.5 percentage point below the November level. So a shift both at the short and medium and long end of the curve, which is good news for both our economic and fiscal forecasts. But again, it's important to emphasize the uncertainty around the central projection. And you can see from the swathes on this chart show you the range of the movements in market expectations for interest rates for both bank rate and gilt yields just in the last 3 months. And you can see that medium-term expectations for bank rate have moved from a high of 4.2 to as low as 2.7% in the last 3 months. And just isolating the interest costs of those sort of movements on our forecast, that would be an equivalent to a swing of a positive 5 billion or negative 3 billion impact on borrowing in the 50 of the forecast, depending on whether you're at the high or low end of that swathe. So a lot of uncertainty around the interest rate path, which could have big impacts on the fiscal forecast. Next slide, please. But perhaps the biggest development for our forecast since November, particularly looking at our medium-term forecast, has been what we've learned about the size and the composition of the UK population. You'll all be familiar, I think, with the problems with the labour market data in the UK at the moment. But as best we can tell, net migration was even higher in the recent past than we had thought in November, reaching have around 700,000 last year. And informed by the latest ONS projections that were published at the end of January, we now expect net migration to settle a little higher in the medium term, up from 245,000 in our November forecast to 315 in this one. But in the near term, we have a reasonably sharp fallback from current elevated levels of net migration towards that medium-term level, and that's largely driven by the significant changes in visa regime that have been announced by the government shortly after our last forecast in November. That pulls down migration reasonably quickly in our forecast to that medium-term level. The effects of those changes are to add an extra 350,000 people to the population by the end of the forecast. But again, we emphasize the uncertainty around our forecast and explore in the EFO the impacts of two different scenarios, a high and low scenario for migration and their impact on the fiscal forecast. Where there are very large impacts on our overall GDP forecast, but not so much for our GDP per capita forecast, as you might expect. The second big piece of news, which ends up being largely offsetting in terms of its impact on our GDP forecast, is that the revised or reissued, if you like, LFS data that came out at the start of February has revealed to us the levels of inactivity are both higher than we expected and with a worsening trend than we previously assumed. And as a result, we now expect our participation to decline over the forecast, and that's due to rising levels of long-term sick, as well as the impact of demographic changes over the forecast. So next slide, please. So moving to the implications of what that all adds up to for our potential output forecast. Well, as I said, the larger population and lower participation revisions we made in this forecast have the effect of largely offsetting each other, and that leaves our estimate of potential output growth pretty much unchanged relative to November at around about 1.6% a year in the medium term, which, as you'll know, is a little bit above consensus forecasts. And that also means that the level of potential output in 5 years' time is also very, very little changed, only by 0.1% by 2028. And you'd have to have a lot of faith in our forecasting ability to think that that is a meaningful difference. So next slide, please. So what does it mean for our real GDP forecast? Well, output contracted slightly over the second half of last year, rather than growing slightly as we'd expected. And thereafter, our forecast for economic growth, as I just said, is largely unchanged due to our unrevised forecast for potential output, due to the offsetting effects, as I said, of higher population but lower participation. But therefore, you can see more of a change in GDP per person because the effects of the lower participation come through, but clearly not the impact of the population revisions. So our real GDP per person forecast is lower, starts lower and is lower throughout our forecast relative to November. Next slide, please. And then finally, just let me talk a little bit about what this means for nominal GDP, which we spend a lot of time looking at because it's such an important driver of our fiscal forecast. So we have slightly weaker nominal GDP growth over the forecast period. That's largely driven by weaker growth in the GDP deflator, matching the decline in inflation, the rest of our forecast. But the more important news, I think, for our fiscal forecast is the composition of that nominal GDP growth, which where our revisions have been relatively favourable for the public finances. As you can see from the chart on the left-hand side, we've revised up our forecast for nominal labour income at the expense of our corporate profit forecast, and with labour income being more heavily taxed, that's relatively good news for the public finances. On the expenditure side of things, we have slightly weaker nominal consumption growth, which is less good for public finances, but that is concentrated in the near term, and again is largely driven by the decline in prices in the near term. Thereafter, consumption growth in real terms and therefore nominal terms is a little stronger, so the share of consumption in nominal GDP recovers its previous level by the end of the forecast. So that's a quick overview of our economy forecast, and I'll pass over to Tom, who'll take you through the public finances.
Great, thanks very much, Steve. So yeah, I will sort of pick up the story and talk about our public finance forecast, a bit about the impact of the policy measures the Chancellor announced yesterday on the outlook, and also just do a little bit of stepping back and look at some of the longer term pressures on fiscal sustainability. So if we could have the next slide, please. So this one just runs through the changes in our forecast for public sector borrowing compared to our previous forecast in November. And the punchline is, as Steve sort of mentioned at the start of his presentation, that actually there's been very little change since November. So these are the changes before the impact of the policy measures the Chancellor announced yesterday. And what you can see here is that because of the lower interest rates and inflation that Steve mentioned, our forecast of government debt interest costs and welfare are lower than we thought in November. That's the blue bars. Sort of roughly offsetting that by the medium term is the fact that lower inflation we also see driving slightly lower nominal earnings and slightly lower nominal consumption through the forecast, and that therefore slightly reduces our forecast for tax revenues. And as I say, by the end of the forecast, those two effects roughly offset, borrowing very slightly lower than we thought in November. It's worth bearing in mind here that both total public spending and total public sector receipts are now well over £1 trillion. So this is really a very small change when you think about it relative to total tax and spend. If we could have the next slide. So this then adds on the fiscal impact of the policy announcements from yesterday. And what you can see, the green bars, is that the Chancellor announced, essentially a package of net tax cuts that increase borrowing in the near term by 13 billion next year, and then are increasingly offset by some tax raising measures, so that by the end of the forecast, the sort of net tax cost is about £5 billion, and that pushes up borrowing overall by 4.5 billion compared to our November forecast. So just to run through those policies, you'll have all, obviously heard about them already, but for the next slide, just to quickly summarize the main elements of the package. The big one, obviously, was the 2p cut in national insurance, which cost about 11 billion. The fuel duty freeze, which cost 3 billion next year, and offset by some tax rises on e-cigarettes, carbon imports, non-DOMs, raising about 6.5 billion by the end. On the public spending side, actually not much change from policy. The biggest change was additional capital spending that the Chancellor allocated to start incentivising and driving public sector productivity reforms in the NHS in particular. Okay, next slide. So just sort of stepping back from that and looking at what is happening to tax as a share of GDP kind of across the forecast period and in recent history, what you can see here on the left-hand side is that we have already actually seen a pretty sharp increase in the tax to GDP ratio. So from its pre-pandemic level in 2019-20, it's already increased by around 3% of GDP to sort of this year. And by historical standards, that is actually a pretty significant increase. And we expect it to continue to grow over the forecast period. So our latest forecast, the solid blue line, sees the tax GDP ratio rising by around another 1% of GDP. And that would take it to one of the highest levels since the Second World War. A big part of the driver of that increase has been policy decisions. Around half of that 4% increase since the pre-pandemic level is driven by policy decisions. The most significant of which is the freezes to personal tax thresholds, which, when combined with the very high inflation we've experienced, has led to very significant fiscal drag, whereby people are pulled into paying tax or pulled into higher tax brackets. And you can see on the right-hand side that that has led to a significant increase in taxpayers and increase in people paying the higher an additional rate of taxation. The tax cuts that the Chancellor has announced at this event and also back in November, the previous 2p cut to NICs and the change to capital allowances have offset what would otherwise have been a bigger increase in the tax to GDP ratio. But as I say, it is still a significant one over this period. Of the next slide. We do think that the impact of the personal tax measures that the Chancellor announced, again, both at this event and at previous events, have had a positive impact on labour supply through the work incentives they generate, which are and these are reasonably substantial. So overall, as you can see in this slide, our estimate is that the cuts to NICs at this event and the previous event combined add around 200,000 people in full-time equivalent terms to the labour force. I mean, most of that is actually from people working more hours rather than more people entering the labour force. But in full-time equivalent, that's what we estimate the impact is. In addition to that, the measures the Chancellor has announced on welfare reform, on childcare reform, we estimate add another around 125,000. Some of that is offset by the fact that the frozen tax thresholds, given high inflation, create a sort of disincentive to work. But that is, sorry, I just got a slight interruption to my screen then. But so that is, overall, the sort of net impact of policy is about 200,000 extra full-time equivalents in the workforce. Come next slide. So turning from tax to public services and public spending, here, not actually shown in this slide, but overall we expect spending as a share of GDP to fall over the 5-year forecast period. And most of that is driven by a fall in assumed departmental spending on public services, which is currently kind of assumed to fall by about 1% of GDP over the forecast period. At the moment, the government has set out plans for public spending only until the end of next year, 2024-25. At that point, the current sort of spending review period ends, and the government has not yet set detailed spending plans for the subsequent 4 years. as you can see on the left-hand side. So we don't have detailed spending plans for that period. We just have an overall assumption for total spending that the government sets for us, and that's what we use in our forecast. And that therefore does represent a risk to our forecast, because it is the case, if you look back at the past, that what has typically happened when governments have actually arrived at spending reviews is that they have increased spending allocations. So that's not to say that will definitely happen next time, but it is a risk for our forecast based on what's happened in the past. And it is also the case that those spending assumptions, those total spending assumptions, imply pretty constrained public spending. So you can see on the right-hand side, the purple bar essentially shows you that the current plans imply that on a per person real basis, you have essentially flat growth in spending over the next 5 years. And that is because since the government originally set those plans, which is the sort of blue bar, we've had higher inflation and we've had higher population, as Steve was talking about, particularly from higher migration. So on a per person real basis, we now have this sort of flat growth outlook. Okay, next slide. So what does all this mean in terms of borrowing, government borrowing and debt? So our forecast is that because of this rising tax as a share of GDP and falling spending as a share of GDP, essentially borrowing comes down fairly sort of sharply over the forecast period, would reach on current policy around 1% of GDP in 2028-29, which would be the lowest level we've seen for about 20 years. And next slide. That also means that public sector debt essentially would stabilize over the forecast period and start to fall slightly right at the end of the forecast in 2028-29. And therefore the government would meet its fiscal target, which is to have debt falling by the final year of the forecast. It meets it by a very small margin, so if we go to the next slide. So the sort of headroom that it has against meeting its fiscal rule is now around £9 billion, which is very small compared to the headroom that chancellors have kept against their fiscal rules in the past. More importantly, it is very small when you think about the risks around our forecast, which are huge. I'll come on to talk a bit more about some of those risks in a couple of slides. Sorry, have the next slide, please. So before I do that, I just wanted to talk a bit about how the government is achieving its target of having debt falling and the sort of challenge of doing that in the current economic and sort of environment. So as I say, government is meeting its target through a tax GDP rise and through spending falling as a share of GDP. And, that is what is required to get debt just sort of stable and slightly falling by the end of the forecast period, which I think, you would see as the minimum required to do if you want the public finances to be on a sustainable path. It would not be a sustainable path for debt to be on an ever increasing trajectory. And that is particularly the case because, if you look back at the past, when shocks hit, and, we can expect shocks to hit again in the future, that has a significant upward impact on debt. So you can see here on the left-hand side the impact of the financial crisis and then the pandemic and the energy price shock on debt, which clearly points to, at the minimum, having debt stable, if not falling, when you're in more normal times. So, there is no easy way to get debt on a stable path. It does require these difficult decisions on tax and spending. And it's more difficult than it has been in the past to get debt on a stable trajectory. And that is basically because of the kind of subdued economic growth outlook and also the higher interest rates that we've got at the moment compared to the recent past. So on the right-hand side, you can see our estimate of the primary balance, that is spending minus revenues, excluding debt interest spending, that you need to stabilize debt given current interest rates and growth. So you can see in the 2010s, governments were actually able to run a deficit and still stabilize debt, whereas now governments need to run a surplus of about 1.5% of GDP to get debt on a stable path. So it's considerably more challenging. It requires more policy action to get debt on that stable path. Okay, final slide coming up. So I also just wanted to underline again, actually it's not the final slide, apologies, penultimate slide. I just wanted to underline some of the longer term pressures on debt, which again, point to the importance of ensuring that public finances are on a sustainable path. So this is just a snapshot of a much sort of bigger and more in-depth set of analysis that we do once a year in the summer, looking at longer term pressures on the public finances and a wider set of risks on the public finances. And these are some projections we do of the longer term outlook for debt based on kind of current policy settings, but taking into account in particular the impact of demographic pressures and an aging population, also taking into account the impact of the transition to net zero. And essentially what this shows is that in the absence of policy change, debt would be on a upward trajectory. That trajectory is looks even more difficult to deal with if you take into account, which the top blue line does, of the impact of shocks coming along on a reasonably frequent basis and pushing your debt level up. Next slide. So this is the final one, but it is a really important one. And Steve emphasized it as well. This is our central forecast that we're presenting, but clearly there's a huge amount of risk around that forecast and a huge amount of uncertainty around that forecast. We try as hard as we can in our analysis to analyze those risks and show the impact of different scenarios or different assumptions on the forecast so that policymakers can take their decisions on the appropriate policy settings sort of in that context. So we look at in this report or in previous reports, we've looked at the impact of different assumptions around inactivity on the fiscal forecast, the interest rate and productivity. And then we also look at the impact of some sort of policy risks. So for example, the fact that on fuel duty, our numbers bake in an assumption, because this is announced government policy, that fuel duty will increase with RPI every year. In fact, that all governments since 2011 have not implemented that rise. And as I've talked about previously, our forecasts also assume that the current assumption for public spending will be delivered. We have seen in the past that, as I say, when governments come to actually do spending reviews, they've tended to increase spending. Okay, so I'll stop there. That is the end of our presentation, and very happy to take your questions. Thanks.
Wow, fantastic. Enormous thanks, Tom and Steve. A lot to digest in those slides. And I would now like to turn to everybody, all our members out there, Tom and Steve have kindly agreed to take questions. We have some time, and you can put those in the Q&A. Okay, so if you just scroll to the bottom of your screen with your mouse, you'll be able to see a Q&A, and you can type on in there. And while I'm still digesting the possibility of debt of 450% of GDP in 50 years' time, I will take a couple of questions first from Chris Naylor. So Chris, thanks for those questions. First up, how confident is the OBR about the potential for NHS productivity increases that you mentioned? There's some money set aside for investment in the budget, and how has the OBR taken that into account? And the second question there is one about that fall in net migration. Could you just remind us what is driving that in your central scenario?
Sure, thanks. So I'll take the question on NHS productivity, and then Steve, do you want to do migration?
Yeah, sure.
Yeah. So on the NHS productivity increase, or investment, I should say. So as I said in my presentation, the government has not set out a detailed plan for spending beyond next year, which includes a plan for NHS spending, and therefore, we have not made any assessment of the impact of the government's proposals on NHS productivity on our fiscal numbers. If it is the case, obviously, that if you want spending public service outcomes to improve in the context of sort of tight spending totals, then public sector productivity increases are obviously really important. And I think, particularly if you look at our longer term projections and the pressures on spending over the longer term from demographics and other factors, clearly it's going to be really important to drive higher public sector productivity in that context. It is also the case that the numbers suggest that public sector productivity has fallen since COVID. And it is also the case that governments have managed to increase public sector productivity in the past. So in the period in the 2010s, the ONS figures suggest there was quite a significant public sector productivity improvement. It's obviously not easy, and we certainly haven't, as I say, we've not made any assumptions that are baked into our numbers at the current point around the sort of productivity benefits that might be generated. I think one thing is also important for us as fiscal forecasters is the degree to which any productivity improvements are cashable, i.e. actually generate lower spending, rather than just generating improved outcomes, which is obviously important for public service delivery, but from a fiscal point of view, what matters is, do they lead to actually lower spending than you would otherwise see? Steve, do you want to?
Yeah, I'd like to on migration. So why do we expect migration to fall back in the near term? Two main reasons. One is that we expect that some of the high inflows recently to naturally lead to some higher outflows in the near term, particularly because much of a reasonable proportion of the elevated inflows have come from humanitarian visas from Ukraine, Hong Kong, and so on. So we expect some outflow from that in future years. There's also a large impact from the policy changes that the government announced. We already knew about the restrictions on visas for dependents of students that was announced back in, I think, May last year. But then in November or December, we also had some Home Office announcements. I think they're all detailed in the EFO, but they included, I think, an increase in the salary threshold for skilled visas, some changes to the shortest occupation list, an increase in the minimum income requirement for family visas. So those all added up based on Home Office estimates that were published alongside that announcement that suggested that would reduce inflows by around 300,000. So it's a combination of higher outflows from recent inflows and the impact of policy pulling that number down. Again, as I would absolutely emphasize the uncertainty around these forecasts, as I did, and in particular, as I say, we look in the EFO at the impact of higher and lower scenarios around that central forecast, and also the impact of different assumptions around the sort of the composition of the migrant workforce and how that could change your assumptions. So we assumed that the flow of more recent migrants have a similar participation rate to those of the resident population. That's because they're mostly of working age. In the past, the participation rate has typically been a little bit higher, but we assume it's more in average this time because the composition is a little bit shifted more into students than in previous flows. So we've opted as something closer to the resident population participation rate. But as I say, we explore what happens in different scenarios where if migration is in our higher scenario, which I showed on the chart, then GDP is as much as 1.5% higher by the end of our forecast on the same assumptions in our central forecast of the same productivity and participation rate. But there's less benefit if the capital stock doesn't adjust. In that case, GDP is only 1% higher from the impacts of high migration. But if participation rates were more like previous migration flows, so much higher than the domestic population, then GDP is as much as 2.2% higher than our central forecast. So as I say, we explore all those different assumptions and the impacts of our GDP forecast in the EFO.
Fantastic. Thank you for that. And I'll take another couple of questions. Do keep coming, sending them in. So we have one here from Jens Larsen. What does the budget mean for public sector net investment? And I've also got one here from Michael Taylor asking, has there been any new work on the economic impact of Brexit? Presumably asking about whether the OBR has done any more work. So public sector net investment and the economic impact of Brexit.
Thank you very much. So I'll do net investment. Steve, do you want to do Brexit? So
yep, sure.
On public sector net investment, I mean, overall, the budget did not announce significant changes to the government's plans for capital investment. There was the increase, which I was just talking about, of funding for NHS productivity programs, which is capital spending to allow the NHS to invest in productivity enhancing reforms. But overall, public capital departmental spending is assumed in the forecast to be broadly flat in cash terms, which means it falls as a share of GDP from about 3.5% GDP now to about 3% by the end of our forecast period. I mean, that is higher than it's been in the past. So it was around 2.5% of GDP, I think, from memory, sort of over the 2010s. It's increased since then. As I say, on the current assumption that the government has given us for capital spending, it's set to fall as a share of GDP. Steve?
Yes. So on Brexit, we as you'll know, we have an assumption in our forecast that Brexit will reduce long-run level of GDP in the UK by 4%. We keep that assumption in the continual review, and we've done that again in this EFO. There's a box 2.4 in the EFO, which goes through our latest assessment. That 4% reduction, we assume largely comes through the impact of lower trade volumes, lower trade intensity coming through to weaker productivity. The latest evidence is consistent with that coming through in the data. The trade intensity of the UK has been appreciably weaker than the rest of the G7. since the UK left the EU, and that looks broadly on track with our initial assumptions. So no particular reason to revise them on that basis. Within the composition of that, we have been a little surprised by the internal composition of the trade flows, where the weakness in goods trade has come through largely as expected, or maybe even a bit more sharply than we thought, but has been offset by relatively strong performance in services trade than we expected, where we think some of the barriers have not come through quite as quickly as we expected, and some of the things are happening there. In particular, it looks like some outsourcing to the US, where services exports have been particularly strong, partly in response probably to some slight weakening in the pound. And there's also some evidence of firms trying to navigate their way around non-tariff barriers by setting up companies within the EU. And as I say, we explore all of that in the box in the EFA.
Fantastic. So box 2.4 is the one to read there. And I'll put together another couple. Fabrice has asked about potential growth assumptions. Fabrice is asking, your potential growth assumption is above consensus and the Bank of England. Why? What are you seeing something that others don't? And another question in the Q&A is about the net impact of policy decisions on labour supply. There's surprise that it's positive when taxes as a share of GDP are so high and forecast to increase. And of course, I think that question is picking up the really interesting work you've done on the impact of labour supply. So a couple of linked questions there.
I think those both for me, Tom. Shall I take those?
Go on. Yeah, thanks.
Okay. So why is our potential output forecast a bit stronger than consensus? I mean, it's a little hard to know precisely, because not everyone produces the same decomposition of their forecasts as we do. Some of it may be due to differences in population assumptions and forecasts around net migration and population, which, as you can see, is an important part of our forecast this time around, and when people took on the latest data from the ONS. But at least part of it is almost certainly likely to be as remaining more optimistic than the consensus on, and also the Bank of England on productivity growth, where we continue to expect productivity growth to return to something in between the levels that we saw prior to the financial crisis and post the financial crisis. So we don't expect a return to anything like the pre-2008 levels, but we do expect a gradual pickup of productivity growth through the forecast, a little stronger than we've seen in the 2010 to 2020 period, which is obviously a very, very uncertain judgment, and probably the most uncertain judgment in our entire forecast. In terms of the difference to the bank, where we're able to say a little bit more, that is at least in part because their assumption around underlying TFP growth is a touch weaker than ours, but also because they assume that the impacts of Brexit come through more quickly in their forecasts than we do. So they have a hit from Brexit, which is a little smaller than ours, only a touch, but that comes through a bit more quickly. So you see more of that over the next 2-3 years with their forecast relative to ours. In terms of labour supply, so I can direct you again to some excellent analysis on our website. We published an article a few weeks back explaining how we model the impact of tax changes on labour supply using the government's micro-simulation model. It looks at the change in gains to work for different individuals and multiplies it by relevant labour supply elasticities for each groups and adds it all up. But the good news is that the intuition is much more simple than that, which is that what is happening with the combination of fiscal drag and cuts to NICs is that the tax base is being widened while rates are falling. So while average tax rates are going up, marginal tax rates are declining. And it's that combination that has the more positive impact on work incentives, and it allows the Chancellor to be able to raise revenue without having a net positive impact on labour supply.
Oh, fantastic. So some more research there for us to read, Steve. I've got a question here about the transition to net zero. It's addressed to you, Tom, but
yeah.
The question is, you mentioned this as a factor behind rising government debt in the long run. Basically, could you elaborate a little further? Could you say about any assumptions you've made on government spending or on the revenue side?
Yeah, sure. Good question. We last did sort of in-depth analysis on this in our fiscal sustainability and risk report, I think from 2021. And we're actually going to do more on this in the report this summer, which I'll say a little bit about. But in that previous analysis, we had a sort of scenario, I think you would call it, for the impact of funding the transition to net zero, which raised debt by the end of the long-term 50-year horizon by around 20% of GDP. And that was driven actually primarily because the government loses quite a lot of tax revenue due to the transition to net zero from taxes such as fuel duty and other taxes on carbon. And we also made an assumption around the amount of public sector investment that would be necessary to fund the transition. We also made an assumption that some of that cost would be offset by additional yield if the government were to introduce taxation as a way of incentivizing the transition to net zero through various routes. I mean, as I say, that was based on a set of assumptions around how the transition might be kind of organized and the degree of government investment versus the use of sort of carbon taxation. And of course, you can make lots of different assumptions about how that might actually pan out over the future. But that sort of gives you, I think, and we did various scenarios around that kind of scenario. As I say, we're going to be doing an update of that this year, and we're also going to look in more depth at the costs of kind of adapting to climate change and to mitigating some of the impacts of climate change, which is also likely to have a fiscal cost on the government alongside the cost of transitioning to net zero. So yeah, look out for that in the summer.
That's a watch this space one, Tom. Fantastic. And we've got a question come in from David Owen. David's asking about something that was announced last year, which was what impact has full expensing had on business investment? What might have happened had we not introduced this? And David also asks, what probability would you attach to the public finances turning out significantly better than you were expecting as a central case?
Maybe I'll start off on this, Chris, and Steve might want to add. On business investment and the impacts of full expensing, so we assumed that would have because it reduces the cost of capital, it would lead to a permanent increase in the capital stock of about 0.2% from memory by the end of the forecast period. I think it's probably too early to say whether there's, I don't think there's any particular new evidence since we did that in November to suggest we'd have a very different view now, but Steve might want to add on that. On the question on the probability the public finances turning out better, I mean, we do a central forecast where we aim for the risks to be broadly balanced on the upside and the downside around that central forecast. So, roughly, we think there's a sort of 50% probability that things could turn out better or they could turn out worse. And I think if you look at the key risks around our forecast, there are both upside and downside potential in all those cases. So Steve's talked a bit about productivity, which is very uncertain, but there's clearly, you can see scenarios in which productivity comes in higher than we're expecting, but also weaker than we're expecting. Inactivity is another sort of I think key risk to our forecast, where the recent trends in activity, particularly from people with long-term sickness, health-related issues for not working, have really deteriorated since COVID, and there is a risk that that could actually continue and get worse. On the other hand, in the sort of period pre-COVID, actually, participation in the labour market had been on a pretty strong upward trend, and the UK had performed better than many of other comparable countries. So, which suggests there's also sort of upside risk there. And then there's other key determinants which drive our forecasts, like interest rates, energy prices, where we essentially use market expectations. And therefore, clearly, there's both upside and downside risk around them as well. Steve, did you want to add anything on business investment?
Yeah, just briefly on business investment. I think the 0.2 you were talking about there, Tom, I think was on GDP, and I think it was 0.5 on the capital stock. Okay. In the long term. The other thing to say is the thing that the change in our forecast in November was the move from temporary to full, and we had previously, when it was due to full expensing was due to apply for a period of 3 years, we had a large spike in our business investment forecast as people accelerated investment plans to take advantage of the policy. But that was largely just a reprofiling of business investment and didn't have the long run GDP effect. When full expensing was made permanent, as Tom says, that sort of reprofiling came out of our forecast. But it did introduce the small long run increase to GDP that Tom mentioned.
Wow, I'm sure Jeremy Hunt's hoping for upside probabilities to come into play, and maybe many others out there. So I'm going to take our final question this morning, because we are coming up to midday, and it is from John Gilbert, and it's an interesting one we don't talk about a lot in the UK, I don't think. Any thoughts on the role and size of the shadow economy and how this fits into growth and labour force participation? Anything you can say on that? Am I handing to Steve?
Well, I hope not. I could say a bit on the public finances, but do you want to say anything on participation labour force?
I don't think we have much to add on changes in the shadow economy. I confess it's not something that we've looked at much recently, particularly in terms of its implications for the labour market and labour force participation. Where in terms of our interpretation, we're relying quite a lot on the LFS data, which is obviously incredibly uncertain at the moment, and does, for example, include a lot of self-reporting, which may be one area where what people are telling the survey collectors isn't what is reflecting their choices in the real world, but it's difficult to get much of a handle on that, even at the best of times, and even more so when uncertainty on the LFS data is as great as it is at the moment. So it would have to be something that is a sort of shift in trend, I think, to be having an impact on growth in our forecast. And I'm not aware of any particular other indicators flashing red in terms of trends in the economic data that we can pass. But I don't know if there's anything to add on the fiscal side of things, Tom?
Well, one thing I was going to add is, so we have a very good box in our report on the tax gap. So the tax gap is the kind of difference between the sort of theoretical amount of tax which is out there to be collected and the actual amount that HMRC collect. And I think, some of that gap could be attributed to what you kind of might call the shadow economy. And actually what we've seen in that data is that gap has fallen over time reasonably significantly, which is in large part due to all of the measures that HMRC have put in place over time to try and reduce that gap and improve compliance and improve the way they collect and digitization and so forth. There's been a particularly sharp fall in the VAT gap, and as well as the HMRC measures targeted on that is quite likely to be due to reduced use of cash in the economy, which obviously makes sort of non-compliance with that more difficult.
Fantastic. So we're looking for a box on the tax gap. That's the one to look out for, Tom. But I was going to ask for a number, but I didn't want to put you on the spot, but I should have known, shouldn't I? We know our boxes. I'm going to bring this to a close now, but look, I just want to say an enormous thanks to both yourself, Tom, and Steve, for joining us here today at the Society of Professional Economists. It's been fantastic to go over what the Chancellor said yesterday, but we've also, particularly through some of the questions, touched on a number of things that didn't come up as much. There wasn't as much discussion on business investment or on net zero. And you've raised some interesting points about the shadow economy, potential output there. And we've also learned a little bit about how the OBR sort of can or can't take into account things like NHS productivity improvements and the like. So in addition to my enormous thanks over to Tom and Steve, I want to say thank you to all SPE members for joining us today and for participating in what is always a wonderful event after the budget. So that's all from me. Thank you very much. And I hope you can both go and have a break now. Thank you.
Great. Thanks very much. Great to be able to do this. Thanks.
Thank you. Bye-bye.